The market doesn't know what keeps you up at night. It doesn't know when you want to retire, and it doesn't know how old you are. The simple truth is, the market doesn't care. But if you care, you've tuned into the right place. You're listening to Investor Resources, bringing clarity to the confusing world of finance. Here are your hosts of Investor Resources, Don Creech and Perry Sykes.
I'm Don Creech.
And I'm Perry Sykes, and welcome to the Investor Resources Podcast.
So the first 3 months of this year have been filled with inflation news, and it's just hanging on. Well, it's actually started to turn back up. So it's turning out that inflation was not transitory, as we were told a year or so ago. And the question now is, how high is high, and is it too sticky to become unstuck?
Right. Now it's one of those times everyone wishes they could see the future because we had great inflation news at the end of last year. Everything was looking good. Everything was heading the right direction. And the prevailing opinion was we're going to start getting rate cut after rate cut because we're heading back to 2%. And lo and behold, inflation had other ideas and is sticking around and kicking up a little bit, in fact.
So there's certainly some things that have backed off that would be traditional inflation indicators. Oil is one of them. In the last week, oil has softened a little bit. The fear of escalation in the Mideast war has subsided since Iran's attack and Israel's retaliation were more or less saying, you're not going to get away with this, but we're not going to escalate right now. Just don't get overly confident about what you can accomplish. And that's probably a message on both sides. They're stuck in a fight for a while. The Houthis are continuing to cause problems with oil shipments in the Red Sea. I mean, there are things that could blow up. There's kind of sitting on the knife's edge, I guess you could say, from an illustration. It could get serious very quickly, but things have backed off. Oil has slipped a little bit. Gold is down a little bit. Silver has backed off. These are assets that people typically use when they're worried about crises, for one, and inflation secondarily. The correlation between inflation and higher gold prices is not real strong. Oil is, but then we have other things that are kind of unwinding this. But while all those are positive signs, long-term interest rates are not falling. In fact, they're ticking upwards. When we saw that particularly with mortgage rates this last week, where they were back above 7%, and at one point where it looked like they were going to go to 8%, which would be really tough on the housing market, would not be a good sign for GDP. But the American consumer is still spending money as though there was plenty of it around. As long as they're spending money.
Not a bad sign. The U.S. consumers showing tremendous resiliency, and they do continue to loosen up that wallet and keep spending. That keeps GDP going on, and that's mainly a function of employment. It's important to remember the Fed's got that dual mandate. They need inflation low, and they want low unemployment. Well, the low unemployment they've got there, they can check that box off. We're okay there, and it looks quite sustainable. In fact, the Fed raising rates has done very, very little to affect the labor market. Employment is high, wages are good, and in some cases increasing still. And as long as everyone's working and everyone's getting paid, that spending is going to stay up there. So that's kind of hard for the Fed to because they wish spending would slow down a bit, but it's the spending is still strong because employment is still strong, and it's going to stay that way for a while.
Well, employment has kind of a dichotomy in it, because while there are strong job numbers, new job creation is basically in part-time jobs.
Sure.
And The
That's
high
true.
level of employment that came through on the latest report, a good percentage of that was government employment. And government employment is not a stimulus for economic growth.
Not
Uh,
exactly productive. Correct. Yeah.
and then we do have continuing spending from the government, which is inflationary, and that's creating problems for the Fed. Fed probably cannot do anything to reduce interest rates at this point in time because Treasury must issue new bonds in order to fund the government. And in our interest expense at the government level is increasing about $400 billion a month. By the end of the year, we're going to have increased our interest carry cost by almost 50%, and it will be more of the federal
Oof.
budget than our defense budget. Anytime that has ever happened in his history, the country that has done that has lost its position as the number one power. This is really a critical time. It is changing, it will change the way the financial markets work, and it is changing the economic and business cycle that we are living in. Economies go through long term cycles, which you get accustomed to. And we've been in a 40-year cycle, low inflation, low interest rates, low commodities, and all three of those are in the process of reversing. So the question is inflation stuck at this level? How sticky is it? Only time will tell. But right now, as I see things, the Fed and Treasury have competing roles. Treasury needs to issue more bonds in order to fund the federal government. The Fed can't change Congress's action, and they can't do anything about inflation if the government keeps pumping money into the system without real productivity attached to it and sending $1 billion here and $1 billion there to foreign wars doesn't do anything to increase productivity here in the United States that would generate economic growth, profits, and wages. None of,
It's
none
true.
of that's working. So,
That doesn't help anything. We do have some good news on the inflation front uh, in contrast to 2022. In 2022, inflation was everywhere. It was very widespread, and it's narrowed down some. We're not quite in the same boat we were in 2022. That's one of the reasons the Fed raised interest rates so aggressively was that inflation was everywhere. It was everywhere, thanks to the world shooting itself in the foot with the COVID response, shutting down, the supply chain globally. Demand was still there, and inflation just took off, and it was in everything. And the Fed was like, well, we'll raise rates. The economy is going to slow down. Businesses can stop raising prices. The consumer is going to stop spending because money is going to be so expensive. And part of that worked, but the problem was the economy didn't cool off, and American consumer just kept right on going, and so that part of their process is not working well. But inflation's narrowed a great deal in this the last numbers. It's down to transportation and shelter, housing. Those were the two big drivers instead of being across the board in everything. So it's becoming a little more, the targets are getting a little more concentrated as to what they need to try to get done. But like you said, Don, if mortgage rates go up, the last thing they want to do is really harpoon the housing market. That it's tough enough right now. They don't have any inventory, and the rates are keeping people out of the market as is. So they're still in a tough spot. Um, but the breadth of inflation is a little better. So it's like there's fewer fronts to fight that inflation battle on, and you can look at that as a good thing for right now. But inflation is still too high. But that's the bottom line. And you can look at, you know, core inflation, super core inflation, any of those you want to pull out. Bottom line is inflation is too high, and it needs to come down more. And it appears that's going to take some more time.
Well, it is, and it shows up particularly in the grocery store, foods.
Sure.
We remember when things were relatively inexpensive. Now that we have a different baseline to look at, say how much am I paying for eggs and milk and bread, and, any kind of protein that we might be buying, and the availability of even fresh vegetables is not certain anymore. Those are all things
Correct.
that affect household operations, and then the cost of gasoline is the other one that's an in-your-face number all the time. Politically, the administration can Mickey Mouse the supply chain a little bit as far as oil is concerned, have some short-term impact on gasoline, but it's short-term. It doesn't really solve the overall supply problems that we are facing. There's just basically no guarantee that we're going to resolve this anytime quickly, and particularly with the Fed having its hands tied. If it
Correct.
drops interest rates arbitrarily, it stimulates more consumer spending. Makes it easier for consumers to borrow money at cheaper rates, which means traditionally in America, if the money's cheap, we spend it. We're not
Correct.
too worried about the amount of debt as long as we can
Problem
afford to pay
solved. Yeah.
it. So that's actually inflationary stimulus. So they're trying not to do that. And we came into the year with the Fed saying we're going to be able to cut rates 3 times. Now, the marketplace felt like that was an understatement, and that we'd see 6 or 7 rate cuts. Well,
Correct.
clearly, right now we're watching as we move through April that the market has decided the Fed wasn't lying when Mr. Powell said higher for longer unless we see real improvement. And so far, that real improvement hasn't shown up. So higher for longer is hard on stock prices, it's hard on bond prices, and it's hard on household and business budgets. The real
Correct.
the real big elephant in the room is what happens with commercial real estate. When you say commercial, that also happens to include multifamily housing projects, shopping centers, malls, big stores, warehouses, and the like. There's a lot of that must be refinanced this year and next year. And with interest rates having, let's just say, doubled from when these original loans were made, it's going to be very difficult for many of them to achieve financing that they can afford, particularly if it's an office building and vacancy is 50%.
Correct.
So that if that is realized in the market, and you end up with forced sales or defaults and foreclosures, that will bring prices down quickly and really shake up the economic view of where we are headed and what it's going to take to resolve this. What the Fed's trying to do is not generate high unemployment. High unemployment in a recession unwinds a lot of stuff. And right now in the market, we're basically looking at unwinding speculation from late last year in the first quarter on high tech stocks, mega cap stocks. And to see that unwind, a 10% drop is a normal market action.
Absolutely.
But that's not enough to unwind the inflation problem that the economy is dealing with and the government in many ways is contributing to.
Absolutely. The Fed's mostly right now playing for time because if we have supply driven inflation issues, the Fed doesn't have any tools for that really. Raising rates doesn't fix that. It doesn't help that at all. So they're just trying to buy some time, I think, and let this hopefully the economy cool down slowly. That's what they're hoping for. They don't want this to happen too fast because they do not want a recession. They do not want large scale job losses, and they do not want a disaster, as you said, down in the commercial real estate market, which means everyone needs time to adjust to new set points where we're going to end up in the economy going forward. Sometimes that just takes time, and maybe the Fed, rightly so, is like, you know what, we may not have to raise rates again, but we're probably not going to cut them anytime soon.
Well, and everybody would like to have inflation dropped significantly. But
Sure.
the reality is that once we get into a period like we have been, cutting back inflation or cutting the legs out from underneath it and getting back to where we were pre-COVID pandemic era is
Yeah.
a highly improbable event.
Yep. Probably not going to happen.
When my wife and I were talking about this the other day, and we both remembered 29-cent gasoline.
Right.
Even during the OPEC crisis, we never got back below that, but below a buck 29, I think, with the OPEC crisis back in the 70s. So the younger folks in Z and millennials, they have no idea how this inflation era compounds and stays around. So getting
Right.
used to things is pretty hard to do. I had a friend over the other day, and he and his son had been to a soccer game here in Seattle, and he said it was $18 for a Big Mac in the stadium.
There you go.
Well, stadium's
Welcome.
usually more expensive, but the last time I was in the stadium, I think it was $6.
Right. Yep.
Uh, I'm not a regular attendee in stadium events, so I can't tell you exactly how long ago that was.
Well, you're going to get real hungry waiting for that to come around again at
I
$6 hot
think
dogs.
so.
So yeah, yeah.
Anyway, you're looking at inflation. You kind of have to get used to it, adjust your budget. We are adjusting our portfolios. In fact, we run 8 portfolios on a discretionary basis for clients and 401k accounts. If you want to know how we do that and how it would possibly impact the decisions you're making in your portfolio, give us a call, send us an email. We'll spend some time with you. We can do a live chat online, just like we're doing this with the podcast. But contact information is down below. Sign up to get regular updates on our podcast. Look forward to the next one. Have a great day.